Mark, let's talk about the markets in 3 minutes, and let's start with that very theme. Why do you think we're seeing this different relationship, new relationship between what we're seeing in yields and the dollar versus stocks? So the fact that we're seeing these lower yields not prompting risk appetite, are we in a new phase when it comes to the relationship between the Fed and stocks?
I don't think we are in a new phase quite yet. I mean, I think this is, just really 24-hour session maybe, or maybe it's a little bit longer, the last couple of days of where we haven't seen stocks go quite as far and then move lower in yields. But you've got to remember, the move higher in stocks in November has been truly extraordinary. It's been an absolutely crazy move in stocks. So I think to be a little bit disappointed that they haven't taken an extra kind of percent higher over the last couple of days is a little bit crazy, a little bit stretched. And we've got to remember we're going to month-end rebalancing as well. So I think that's the only dynamic here. I ultimately think that going into year-end, it's the stocks rally that's probably got a little bit more room to run on this. So, no, I don't think the dynamics changed. I think we're still trading the idea that bad economic data is good for stocks because it does mean lower yields. At some point, that'll run out of steam because if we keep on getting worse and worse economic data, well, that means we've got a bad growth scenario, and that's bad for earnings, and then these stocks rally can't continue. But I don't think we're in that environment yet.
OK, so we haven't seen that change yet, so bad data will still be good for stocks perhaps in the short term. Let me ask you about what's been driving the Asia session, because there has been some real negativity around Hong Kong, and some people perhaps surprised that the headlines around the US and China, slightly better mood music perhaps around the House in the United States and their plans towards Chinese business, that is not driving more positivity, more risk appetite through the Asia session. Perhaps that story a little more nuanced. What do you think is going on there?
Yeah, that story is definitely more nuanced. I mean, this was obviously a question you were going to ask me, Anna, and yet I didn't bother researching the answer. I don't really know why Hong Kong stocks are so much weaker. We did think when this story broke that this should be a positive at the margin. We weren't expecting it to be a game changer, but we thought it was positive news. And instead, stocks that were already suffering just suffered more since the headline. As you mentioned, the story is a little bit more nuanced. It's not necessarily a change of plan. But it should be a non-story rather than such a negative. Why are Hong Kong stocks really suffering? I wish I'd really researched the answer to that one. I don't know. Ask me the next one.
Well, OK, I'll ask you the next one. It's about New Zealand, but actually the wider read-across, if there is any, from a hawkish hold in New Zealand. I wonder if this is a sign of the times, a sign of the future.
I think that's what we've been seeing already, is central banks want to insist on this idea of higher for longer. And we've got to remember that central banks are going to want to talk hawkishly. We talked about at the top of the show the idea that there's been such easing of financial conditions for the Fed that they're going to have to sound hawkish again in December, even if they're aware they might be cutting rates in the first half of next year. They can't entertain that idea explicitly yet. So every central bank is going to talk about the idea, we're going to hold rates here, but we're going to hold rates up here. But ultimately, many of them are going to cut much sooner than they're promising. It's the exact opposite dynamic we saw a few years ago, where central banks weren't talking about hikes and then suddenly had to hike aggressively.